So as we compare these three flagship funds, SPYI, QQQI, and IWMI, what we find is we have one clear winner throughout the year except for right at the end. Though total returns tell a different story. And by the way, did you even know that this fund was part of the NEOS family of ETFs now? What's up, you guys? Welcome back to the Average Joe Investor channel. We are continuing our journey through all of the high yield ETFs out there, and there are a lot of them. We've previously covered all of the covered call ETFs across multiple different fund families. We most recently talked about the Round Hill Zero DTE ETFs, and today we're talking about the NEOS funds, which include SPYI, QQQI, IWMI, and a few others. Truth be told, there were a lot of people who really wanted to see these funds be part of the covered call ETFs, but they're not technically true covered calls because they have extra strategies available to them depending on circumstances. So we'll make sure, first off, we know how all of these funds work. We'll take a look at the spreadsheet that I built to look at the actual performance results since origination, as well as along the date and time frames that are going to fit into the high yield fund master spreadsheet we're building. We'll take a look at how these funds have performed against their underlying indexes, and I've got a few surprises for you at the end as well. Let's dive in. All right, so we're looking at the NEOS ETFs. Here are the specific ETFs we're going to be talking about here. The flagship ETF here, the one with the oldest history, but also the one that is most well known, I think, across all of the NEOS funds is SPYI, the S&P 500 High Income ETF. We'll also talk about the NASDAQ 100 version of that, QQQI, the Russell 2000 version of that, IWMY. There are also some brand new funds we'll at least talk about since we don't have enough history to really review them. And there's a few funds that NEOS actually took over for other companies, including NUSI, which used to be nationwide, but NEOS actually took over them. We'll talk about that in a second. We've got a Bitcoin High Income ETF here that's new. We've got the Enhanced Income Credit Select ETF, HYBI, which was transferred from a different investment company. We have BNDI, the Enhanced Income Aggregate Bond ETF, CSHI, the Enhanced Income 1 to 3 Month T-Bill ETF, and then TLTI, which is also brand new, the Enhanced Income 20 plus year Treasury Bond ETF, which is probably very similar to TLT and TLTW. We'll focus our attention first on SPYI because it's a unique, different type of strategy that I want to make sure you guys understand and understand how it's different than other types of true covered call ETFs. So let's look down here. SPYI, the target benefits of this strategy: the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven covered call, a call option strategy. So they own at least components of the S&P 500, though they might not own exactly the specific elements, and of course the same segmentations as the S&P 500. And then it says, actively managed by NEOS or NEOS, the fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. So quick note here, most option income you receive, whether it's put option income or call option income as an option seller, is going to be taxed as ordinary income to you, which is going to be short-term capital gains tax rates. However, with the 1256 contracts, which are NDX for the NASDAQ 100, SPX for the S&P 500, and RUT for the Russell 2000, that option premium is actually taxed at more beneficial rates, known as a 60/40 split, 60% long-term capital gains, 40% short-term capital gains. So all other things being equal, you earn the same amount of premium with the two different indexes, but you're going to keep more of your income by utilizing the main indexes, though they are much larger, so it's hard for most individual investors to do it. And then third here, the fund utilizes a call option strategy that may include both sold and, this is key here, purchased SPX index options, which may provide the opportunity for upside capture in rising equity markets. Before we continue, let's take a look at the prospectus to make sure we understand what they mean by that. All right, this is for SPYI, the principal investment strategies of the fund. So it's an actively managed ETF, blah, 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 blah. Under certain circumstances, the call option strategy may include transactions with covered call options. We're familiar with this already. The fund seeks to generate high income from the premiums earned from the SPX call options as well as the dividends received from the fund's equity holdings. The SPX call option seeks to generate a net credit, meaning that the premium received from the sale of the call options will be greater than the cost of buying the long out of the money SPX call options. Very interesting. The SPX option strategy is intended to generate high monthly income in a tax-efficient manner, with the potential for upside appreciation when the underlying equity index appreciates. There's some information here regarding 1256 contracts and tax benefits. We'll skip that for now. All right, so here's the key I wanted to focus on. This is why this is not a true covered call ETF. The fund's options strategy typically consists of at least two components: written or sold call options, that's your covered call component, on the S&P 500 on up to 100% of the value of the equity securities, and right here, using a portion of the premium received to buy out of the money call options on the same reference index to provide the potential for upside equity participation when the underlying index appreciates. Okay, so in case you got lost here, what we're talking about is selling covered calls, but taking some of that premium you receive as an option seller and purchasing out of the money call options. Now, why would you do that? Because when you purchase call options above and beyond your strike price, as the market, if the market goes up in value, normally with a covered call, you would be capped at whatever your strike price is on your covered calls. But if you also purchase a call option above and beyond that strike price, you will, as the market continues to rise, especially in situations where the market zooms past your strike price, you get to participate much more in the value or the increase of the S&P 500 when that happens. Now, of course, if the market doesn't go up in value, those out-of-the-money call options you purchase will end up being worthless. So that is why you would expect with this fund to, at times, perform well, right? And to go very close to, and from very close to the S&P 500, but at the same time, most likely lag the main index, as well as lag most funds that are true covered call plays, because it's kind of a blend between the two strategies where you're gonna get more capital value, or less capital erosion, I guess is a better way to say it, but also less income along the way as well. And by the way, this strategy here, like we talked about with SPYI, is gonna be the exact same for QQQI with the NASDAQ 100. With these are known as call credit spreads, where you're selling a call option and also purchasing a call option. It's going to be a net, it's technically a credit spread here because you're collecting more in the income than you're paying out in the actual debit portion with the actual purchased call options. And this will also be the same with the Russell 2000 and IWMI. Okay, so let's dive into the results here. What we have are all of these funds. Now, obviously, some of these funds are just totally apples to oranges comparison. So the goal of this spreadsheet is not to necessarily compare them, but there is going to be a section where we can compare the results of these funds to their underlying indexes just to understand how they're correlated with each other. But like, for example, we're not going to compare CSHI, BNDI, and these funds here to the equity ETFs. It doesn't make sense to do that. They serve a different purpose. Something like CSHI right here is meant to hold as like an equivalent for like an emergency fund as opposed to investing in the stock market. So the results are going to be different. Same thing for right here, HYBI and TLTI. But for full awareness here, these funds, we don't really have enough data to look at anything more than just like a few months. So we're not really going to compare them very much in this video. IWMI, TLTI, HYBI, and BTCI. We will have the ability to look at 6 months for all of the other funds, and then 1 and 3 years for 4 other funds. As we can see here, we've got the time frame up here, and we're gonna have 2 different scenarios where in all these cases, it's gonna be a $100,000 lump sum distribution at the beginning of the period, no additional contributions. We're gonna look at living on the dividends, where we are not reinvesting dividends, but just living on them, right? Which is pretty common with income investments. Or on the flip side, since I've got a number of feedback from people saying, hey, I wanna know what would happen if you reinvested the dividends. Even though it doesn't generally make sense to do that in most cases, I do wanna make sure that that information is available to you as well. So we'll look at reinvesting dividends, how much income you'd receive, as well as portfolio balance. And then over here with living on the dividends, we'd have income during the time frame, portfolio balance, and total return. As you can see, we've got the symbol, the fund name, the amount of assets under management for each fund, the dividend yields currently, the expense ratio, the inception date, as well as the distribution frequency. Now, really quick before we get started here, HYBI technically was launched back in 2014. However, because they changed ticker symbols when they switched over to NEOS, I tried multiple different outlets to try and get the price and history data, price and dividend data. Couldn't find the accurate information there, so I did not include it. So let's dive in here to the 3-year returns from January 2022 to December 2024. And I've got a ton of graphs to show you, so make sure you stay all the way to the end. First off, we've got, in this fourth section here, we've got NUSI, SPYI, CSHI, and BNDI. Now, you can compare CSHI to BNDI if you want to, but they're also not apples to apples. Same with NUSI and SPYI. Now, really quick, NUSI, just to make sure we're on the same page, NUSI is actually a fund that's a collar spread, a collar strategy. Instead of just selling covered calls or doing call credit spreads like you would see with SPYI, instead what they're doing is they're trying to collar their market. They are selling covered calls, that's a top cap, and then they're also purchasing protective puts on the bottom half to hopefully protect against a large market decline. So it kind of collars the market here, top and bottom. So you expect that in the same way that SPYI is going to lag the overall index because they're using some of their premium to purchase call options. Same thing with NEOS, they're going to lag the market at times because they're purchasing put options to protect against a large market drop. That's why it's called here the NASDAQ 100 Hedged Equity Income ETF. Okay, so here are the results here. First, I guess you could compare NEOS and SPYI if you wanted to. You can see that the income for the living on the dividend section would be $19,238 over 3 years. Again, this is based on $100,000 invested. And then $25,000 for SPYI. Portfolio balance would be 138 for NEOS versus 107 for SPYI. Very interesting. For a total return difference of 157 and then 132. Now, CSHI, again, it's more like a replacement for holding cash in an emergency fund. It's holding 1 to 3 month T-bills, but also selling options, or selling put options, I believe, on the SPX index. So here they collected $12,000 over 3 years, and then $10,000 for BNDI. And then you can see that their value is $99,000 versus $95,000, and total returns are 111 versus 106. Now, if we are reinvesting these distributions along the way, for NEOS and SPYI would be at $20,945 versus $28,887, and then portfolio balance would be 163 versus 137. And then with CSHI and BNDI, we'd have 112 and 106 for portfolio balance if we're reinvesting dividends, and then 13,000 and 11,000 for income. These other funds here are not available at this time, but we will incorporate them in the future as they if they have more and more data available. All right, next up, let's take a look at the 1 year returns. So same idea, living on the dividends and reinvesting dividends. Now, with the 1 year, we have the same 4 funds. So we'll look at those next. The 6 month is where we can look at a few additional funds. For NEOS, we have 7997 for income for the year versus 11665 for SPYI. For portfolio balance, we have 119 for NEOS, 107 for SPYI, for a total return difference of 127 versus 119. And then for CSHI and BNDI, here we've got 5250 and 4890. Again, for BNDI, they essentially own underlying index ETFs from Vanguard, BND. Then they also sell put options on the SPX, which is where they generate the majority of their income. So we've got 5250 versus 4890. And then $100,000 in portfolio balance versus $97,283 for BNDI. For a total return difference of 105 versus 102. This is again over 1 year. For reinvesting dividends along the way, you'd be at 5378 versus 5003 for the income for these two, and then 105,500 for portfolio balance and 102,237 for BNDI. So let's go ahead and move on here to the 6 month return. With the 6 month returns, we're able to include one more ETF, which includes QQQI from NASDAQ. They were launched in January 30th, so they didn't quite make the full cut for the full year 2024. So for the 6 month returns here, top result for income here was QQQI at 73.46 compared to 63.05 for SPYI, and then 42.29 for NEOS. We have some lower numbers here for BNDI and CSHI, of course, which is what we should expect. Portfolio balance, the top result here was NEOS at 110.229 versus 105 for QQQI versus 104 for SPYI. And then we've got 100 here and 99,993 for BNDI. Total return numbers, best result here was NEOS at 114 versus QQQI at 112. And then SPYI at 110. If we're reinvesting dividends along the way, top result for income was here at QQQI at 75.74, then SPYI, then NEOS, and then the two bond or cash funds here. And then portfolio balance, if we're reinvesting dividends, would be 114 for NEOS, top result, and then second would be 113 at QQQI, followed by SPYI, and third at 110. We also have since origination here, but this is truly an apples to oranges situation, except for these three right here, SPYI, CSHI, and BNDI. These are all launched on the same date here, August 30th, 2022. But they're not really apples to apples comparisons because they're different types of funds. We've got an equity fund here, T-bills, and then we've got bonds. So there's really no value in comparing these two. But what this data did allow me to do by collecting all of it here is it allowed me to get a bunch of graphs here based on their underlying indexes. First off, we've got NEOS versus the NASDAQ 100 here. So we're looking at both portfolio balance when we're not reinvesting dividends as well as when we are reinvesting dividends. In the light colors is going to be without reinvested dividends. The dark color will be with reinvested dividends. And this is again since NEOS origination. And one thing I want to point out to you is right here. This is when COVID happened. You can see the actual real value that a fund like this, a collar, ETF could provide if the market dips significantly. Where the market dropped all the way down here, the NEOS fund dropped here and then came back up faster. Now, ultimately, in the end, it didn't keep up with the performance of the NASDAQ 100, nor should we expect it to, but it does provide a little bit less volatility as a result with the portfolio balance. Ultimately, you've got here in light red and light blue, significant differences between the NASDAQ 100 and NEOS. Even if you're reinvesting dividends, there's quite a big difference, $150,000 versus in excess of $250,000. Let's take a look here at SPYI versus the S&P 500. Light colors, again, not reinvested dividends. Dark colors are with reinvested dividends. This is the portfolio balance over time. You can see that in the pink, we've got SPYI, and in green, we have the S&P 500. And naturally, as you would expect, the S&P 500 outperforms on capital value. Though you can see that SPYI did a pretty good job here with reinvested dividends, which is another fancy way of saying, essentially almost total returns. Right here, when you factor all of this together, it performed much better than if we're just looking at the capital value without the total returns. Here's a look at CSHI against a 1 to 3 month T-bill, which is BIL, the ETF. You can see that the funds are pretty much the same without reinvested dividends, but when you reinvest that option premium you're receiving, the distributions, you can see that CSHI clearly outperforms just holding a regular 1 to 3 month T-bill ETF. Same thing here with BNDI, which is that bond fund with put option premium from the S&P 500. If we compare it to the underlying index from Vanguard, BND, we can see that the bond fund outperforms on a capital value perspective when we're not including those distributions, because light green is the bond fund and then light red is BNDI. But if you factor in reinvested distributions along the way, we see that BNDI does in fact outperform BND, mostly due to that extra premium being reinvested. All right, let's get some fun stuff here. So we're looking at QQQI versus the NASDAQ 100. Now, in pink we have QQQI, and in green we have the NASDAQ 100 QQQ. Now, obviously, we see that the QQQ outperforms on capital value during this time frame, but when you reinvest dividends, it's actually much, much closer. And at times, QQQI was outperforming QQQ here in early 2024, and then it was really close here in this section around late 2024, but ultimately at the end of the day, especially with the most recent bounce in QQQ, it actually outperforms QQQI. Now this one I thought you might find fascinating. This is QQQI compared to QDTE from Roundhill, which does a similar but not the same type of strategy. What it does is it actually holds LEAPS contracts or LEAPS call options as opposed to holding shares. And then it sells 0 DTE covered calls every single day, but no overnight exposure. They open the contract and it expires or it's closed the same day. So in green, we have QQQI, and in pink, we have QDTE. And what we find here is that QQQI has much better portfolio value when we're not factoring in distributions. That's the green line right here, compared to pink, which is QDTE, which actually loses money. Went from 100 down to about 90,000, and this is just since March 2024, which is when QDTE launched. In the lower numbers here, this is the income along the way. And you can see that QDTE generates significant, far more significant option premium or distributions than you get with QQQI here. And then if we scroll over one more time, we get the total returns. This is total returns for those same two funds during that same time frame. We can see that QDTE, when you factor in those distributions into those total returns, QDTE just slightly outperforms QQQI right here, 118-ish, 118 to about 117. We have IWMI versus the Russell 2000 here. This is a very short time frame from just late June to end of December, so just under 6 months. In pink, we have IWMI, and then in green, we have the Russell 2000. As we can expect, we can see that not reinvesting dividends, it underperforms the index. But with reinvested dividends along the way, it performed much, much better. It never really outperformed the index during the year, but it got really close at times to matching the performance. Here's one last fun one here. Wanted to get an apples to apples comparison with IWMI, QQQI, and SPYI. Now, it's the same type of strategy, but different indexes. So it's not truly an apples to apples comparison. It's more like an Granny Smith apple to Cosmic Crisp apple, which, by the way, Cosmic Crisp apples are by far the best apples on the planet. And you're wrong if you disagree with me. So let's take a look here. We've got since June 26, 2024, which is when IWMI was originated. We've got from the beginning here, In red, we've got Russell, green, we've got SP 500, and then pink, we have the NASDAQ 100. And you can see that throughout most of this year, the Russell 2000 ETF was outperforming the other two up until the end, the middle or beginning of December-ish, when the Russell 2000 dropped quite a bit and then is building its way back up. That's just capital value. Now here down below, we've got distributions, and what you'll find is in red, we've got the Russell 2000, which you'll find almost always is the Russell will have slightly better option premium than the NASDAQ, which will have far more income than the S&P 500, which we can see right here. But let's take a look at total returns, because these two numbers in itself need to be combined for total returns, and which we have right here. Top result here throughout most of the year by far was the Russell 2000 IWMI, but it tanked really hard here right around 12.15, 12.18 actually, and it ended up being in last place amongst the three of them. Top result was QQQI at the end of the time frame of 112, compared to in green SPYI 110 or 111ish, and then Russell 2000 or IWMI at 110. So very close, but ultimately at the end of the day, the Russell 2000 recently dropped, which is why it's in last place. As a reminder, we're still building out this ultimate high yield ETF review, which is going to include all the ETFs we talk about here, the ones we talk about in individual sessions of certain fund families. We're going to include them all together. It's going to be probably over 80 to 100 of them in total, and then we'll be able to kind of segment that out as well when we look at different situations, what's the best underlying index, or which ETF tracks the S&P 500 the best, or the NASDAQ 100 the best. There's going to be a ton of value once that's all built out. So key takeaways here. These ETFs, do they make sense for you? Well, maybe. It depends on what you're trying to accomplish. With all these funds here, because they use this call credit spread strategy, they're giving up some of their income to hopefully track the index a little bit better, especially when the market is in a bull run. So what you'll find is if you need more income, you might need to go with something more like QDTE or XTTE, or maybe the Global X funds, which generate significant option premium. But those funds do a lesser job, or a less quality job, of tracking the index, and you're going to experience more capital erosion along the way. So for more capital value, more of a blend between the two, these funds from NEOS might make a lot of sense. If you want access to this spreadsheet and all of the spreadsheets I create on this channel, especially these year-end reviews, make sure to check out the Average Joe Investor Patreon community. There's a link down in the description below, and an opportunity, if you really want to just purchase this one spreadsheet as a one-off. The Average Joe Investor Patreon community has tons of value though, and it's got a great DIY investor community. If you want to learn more about that, again, check out the link down in the description below. Hopefully this video and this spreadsheet added a lot of value for you. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many of those comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.